people in.
Good. Good morning, everybody.
Good morning.
Good morning, everybody.
Morning.
This is fun. We have 4 moderators.
It's my favorite day today.
Awesome.
Alexa,
Tuesday.
Taco Tuesday.
Taco Tuesday, yes.
What do
Might
you
head
got
down
there?
to your
Zona Fresca? Have you guys had the Zona Fresca tacos? They're so good.
It's good. I have actually. It
The
is
fish
yummy.
tacos, man.
Yeah, we got a lot of moderators to hold you down,
Yeah,
Jose.
good. I love it. Makes it
You
more
know,
fun.
those accountants are very aggressive. These accountants are very aggressive.
You got to put on their Happy Taco Tuesday. I got it.
Good morning, guys. Where are you guys from today? We always like hearing from the chat. Do we have any people outside of South Florida? Tina, good morning.
Yeah, where's everybody from? I like to know as well.
Yeah,
Miami.
Brandon's from Miami, Dania.
yeah, we've had some people from like in Colombia before. We had some
Yeah.
Cali people, California, that is. We've had people from Chicago. Hello.
Oh, Lance Minto. I know Lance. Morning,
Hey,
Lance.
Lance. Yep. One of our new students.
Welcome.
And all the way from Boca.
Do we get new people every webinar, or there are a lot of them are repeats?
Yeah, we get a little bit of everything. So to help out Jose, that's a great question.
Mhm.
If this is your first webinar, put it in the chat. Hey, Esther,
Good morning, Esther.
Get some of our students on here.
I see that. Yeah, a lot of the students are on here. That's good.
Yeah.
See some clients on here. That's great.
Yeah. So if you're trying to call Jose right now you know why he's not answering.
Yeah.
He's on a webinar.
All
I got a couple
right.
people first.
You guys can call Gene. He's in the office.
I mean, who wants to hear the accountant talk? You're not an accountant, you're a tax strategist.
Yeah, I don't consider myself an accountant anymore. I used to be.
Yeah.
Now it's like I'm a strategist, financial tax strategist. Makes it more interesting, more fun.
Yeah,
You
exactly.
get to get more creative this way, you know? Not just doing compliance work.
Much better.
Compliance, how boring.
Yep, give a
Get
couple more
creative,
minutes.
guys. Let's get creative.
Absolutely. Yep, and just so you guys know, our webinars will be on our YouTube channel in the next 2 or 3 days. Make sure you subscribe, Broward Real Estate Investors Association. All our events that are free will always be on our YouTube channel too, so you'll enjoy it there.
Yes, good. You know what? I should post on here my YouTube channel as well. You guys can help me.
Yeah, go for
it. I do post tax tips on there, and I'm starting to post more. I'm going to start posting more in the coming weeks. And I'm also going to put in the chat my Instagram handles, so you guys can follow me, because I do post tax tips on my stories.
Good stuff.
I was just gonna follow you to see where you go out to eat, where you get your tacos, where you get your cigars.
Or what part of the world I'm in. Yeah.
Oh,
Jose fan club.
Now that we can travel, man, it's dangerous.
Jose with his scotch and cigars.
Yeah. All the cigar spots that I visit. Yeah.
Exactly. So we'll give it 35 after. I know we have a lot of information going on today. So I say we get started. Whoever's late, you snooze, you lose. Half the
Okay.
battle is showing up on time, is what I always tell people. If you show up on time, that's half the battle, or just showing up, I guess.
Yeah. Excellent.
On that portion. So my name's Anish Dave. I am the CEO of the Broward Real Estate Investors Association, the Miami-Dade REIA, WJL Properties, all the above. I also, if you're looking on the screen, we have our two favorite people, or actually three, I guess. Jose maybe is my third favorite. So
Aw.
the young ladies, which is Alexa Para, Alexa Marie, our office manager, our admin assistant, Alexa Marie. They are the ones that have Bria running. Otherwise, if it was myself or Ryan, nothing would be working. It's probably what I would say. We'd probably miss the webinar ourselves. So they're the ones that keep us track. So if you ever call our office, or if you really need to get something done with Bria, maybe your membership, anything that registration, the idea is to call them or email them because they will get it done. Me, sometimes, I'm not sure. I'm not as good as, the girls are. So, and then, enough about me. Let's talk about the main event, Mr. Jose Ramirez. So if you guys are just hopping on, he is not an accountant. He's a chief tax strategist. So I think there's a big distinction. We always joke about it. All accountants are not created equal. He is also an investor. He's been supporting Bria and Miami-Dade REIA for, I want to say about 8 years, 9 years.
About that, yeah. We've been around for
around there. So almost a decade. So, he's on top, and a lot of you guys might have actually seen some of his webinars in the past. We constantly have him on the webinars because the tax world is constantly changing, right? New election, Biden's new plans. I know you might touch on some of those things, and there's always newer strategies that he's working on. So what I'm gonna do is pass it on to Jose. And again, I know some of you guys are new, so if you got questions, put them in the Q&A. If you put them in the chat, the chat moves a little too quick. We'll make sure we get to all the questions of Jose. Again, there will be a replay of this webinar in 2 days. So Jose, the floor is yours, my friend.
Excellent.
So,
thank you, guys. Welcome, guys. My name is Jose Ramirez, Chief Tax Strategist with Advanced Tax Advisors. And I know that we have a lot of students and clients on the call, but I know there's some new people as well who don't know me. So a little bit about me. As Anish mentioned before, I don't consider myself an accountant anymore. I used to be an accountant many years ago, from corporate controller to, business management and that sort of thing. Transitioned into taxation maybe 10 years ago. And I found it to be more of my thing, right? I got to be more creative, and understanding the tax laws and the strategies that we can implement in clients' businesses. So I find it to be more fun. So put in the chat who's watched me speak before, who's attended one of my webinars in the past, and who is new. I'd like to see who's new, who's never heard of me before, and who has. We're not going to be doing polling questions because I want to give people the opportunity to ask questions so we can address them on the webinar. All right. Let's see. What are we hearing from people? New. We have a few new people. That's good. Okay.
Look, David, you've never heard of Jose Ramirez? Come on now.
That's kind of hard to believe, being that you're in South. If you're in South Florida, you heard of me. All right.
I might have heard of a Jose Ramirez, period. So it's a little common name, but
have the most common name
Jose.
in the world, Jose Ramirez. I mean, you've heard of a Jose Ramirez before, right? Excellent. All right, so I'm going to share my screen so we can get started. What do we do here? There's something happening here. Okay, here we go. Okay, you guys see my screen okay?
We see it. You're perfect.
Okay, excellent. So we're going to go over a little bit about what we're going to talk about today. We're going to review the the Biden tax plan, and we're not going to go too much into detail on it because it hasn't passed yet, right? It's just it's out there for is being proposed and is being reviewed, and it still has to go through voting and all that good stuff. So we just want to have an understanding on what's coming down the pike. All right. So a lot of the changes are going to be, as you may have heard, a lot of the changes are going to be for corporations and people making over $400,000 a year. So first change in the corporate rates is going to go back up to 28% from 21. Well, I shouldn't say it's going to go back up. That's the proposed rate, 28%. They're talking about restoring the 15% corporate AMT tax on businesses over 100 million. Again, this is a broad view because it doesn't apply to most of us, right? If you're making 100 million a year, you really need to call me. All right. Double the GILTI tax, which has to do with international business affiliations, which most of us don't do, being that we're in real estate here in the States. Biden is proposing changing the tax rates to what they were in 2017. This is what the tax rates are now, right? They start at 10%, they go all the way up to 37. 37 is the cap. What Trump did is he lowered the tax rates, but not only did he lower the tax rates, he increased the ranges. So now you're being taxed less on more income, if that makes sense. All right, I'll show you the 2017 tax tables next so you kind of get an idea. 37% on 500 to 600 as opposed to 39% down here. Oops. 39% down here on 418 and above and up, right? So that's a big difference. Not only did the tax rates get lower, but the ranges went up. So that was a big deal with the new tax laws. So Biden is talking about bringing the old tax rates back. So we all would be paying higher taxes, not just the people making 400,000 and more. So that, in my opinion, that's a misconception, and that's being put out there erroneously. All right. These are the individual rates over the years. As you can see, 2011, 2012, and then this is when Obama took over. Obama raised the taxes here to 39.6, and then Trump brought them down to 37. 2018 through 2021, 2022 should be the same. Nothing's changed, but that's what's coming, right? So we talked about restoring the highest tax rate to 39.6. Biden's also talking about eliminating the long-term capital gains tax, which is currently at 15%, up to 20%, depending on your AGI. He's talking about eliminating it for people who have adjusted gross income of over $1 million, which would affect people that have multiple assets, right? Not just people that are making $1 million, but people that are trying to sell real estate over $1 million with capital gains and over $1 million. He also wants to impose the additional Social Security tax and Medicare and Social Security tax on individuals earning more than $400,000 a year. So in addition, on top of your 15.3% that you're already paying in Social Security and Medicare, which is your FICA tax, he'll be adding the 12.4 to individuals earning $400,000 a year. Now, that's not just employees with a W-2, but it's also on partnerships, self-employed individuals, right? So it affects everybody. And let's face it, if you're a successful business owner and you're successful in real estate, you're probably making more than 400,000. So it would affect you, all right? Okay, he also talks about eliminating or trimming down the QBI deductions. I don't know if you guys remember, but Trump passed this new deduction that we didn't have before, which is called the qualified business income deduction. So anybody that's operating a business, whether you're an S Corp, self-employed, and you have net income in that business, you were allowed to take 20% of that income as a deduction. And that was just a free gift that he gave everybody, 20% deduction on your income, right? He's talking about removing that and putting a cap on the itemized deductions, restoring the piece limits, and it would limit your deductions, your itemized deductions to 28% of the expense. So what does that affect? It affects your mortgage deduction, your property taxes deductions, your donations. So you'll be limited as to on what you can deduct on your itemized deductions. Is that making sense? I mean, most people itemize if you own a home and you have donations, charitable contributions, things of that nature, you're probably going to itemize, right? You're deducting your mortgage expense, you're deducting your property taxes, medical expenses, and donations. So this would change that. This would put a limit on how much you can itemize. Everybody with me?
Yep, so far so good.
All right. Okay, let me just look at my notes here. Okay, it's not all bad, right? That is the bad. That is the bad, the ugly. He's also expanding the child tax credit. He's extending it to $3,000 per child. And if your child is 6 years old or below or younger, there's an additional $600. He wants to restore the first-time home buyer credit. And add a couple other credits regarding energy. All right. Estate plan changes. He wants to drop the unified credit from 11.7 million to 3.5. That is the lowest we've had it in a while. We would have it in a while. If you guys remember, Trump increased the estate tax from 5.4, I believe it was, to 11.7, meaning that if you accumulate all these assets over the course of your life and your business appreciates, whatever the case is, and you retire, or I'm sorry, you pass away, you leave all your assets to your heirs. Your heirs can get your assets without paying any tax, right? There's a step up in basis. You get the benefit of having the value of the property when you receive it as your basis in the property, and there's no tax, right? Up to 11.7 million. He wants to lower that to 3.5. And then he wants to increase the tax rate from 40 to 45% on estate taxes. So anything that you receive over 11,000 right now, you pay estate taxes. But if
11 million.
Up?
Over 11 million.
Over 11 million, right. So, but he wants to lower that to 3.5.
Yeah, so I mean, what's really important, again, these haven't gone through yet, but if this does happen, right? Why I think it's important is as your first job as you're growing your business, you're getting more properties, and what's really important about this is if you're trying to leave a legacy, right? You want to leave it to your kids. You work so hard, and then you have Uncle Sam taking 40 to 45%. So the reason it's important to know these things is if you're going to want to have some sort of estate planning, like a tax strategy, because otherwise, if you leave, I'm just going to use the $10 million, that's $6.5 million that would be taxed. Well, how many people have 40% of $6.5 million or 45% sitting in cash, right? You're going to have to actually liquidate probably your properties unless you actually have some sort of estate planning out there. I think the most famous one, you probably hear this all the time, is I don't know how many of you guys are football fans, but Joe Robbie, the original, the owner of the Dolphins before Wayne Huizenga, right? And he did not have any estate planning whatsoever. So unfortunately, when he passed away, including the stadium, he got hit with the Robbie family got hit with a massive tax bill.
Yeah. And
that's when he sold to Wayne Huizenga. So
I think the same thing happened to Prince recently, right? He didn't have any estate planning, and he's got a huge estate tax going on.
Yeah. So, I mean, again, you want to know what's happening. Some of you guys might be new and you're just starting to build your wealth, or you have, family, your family owns businesses or buildings. So you want to make sure you got this stuff covered.
Now, these are things that you probably should have learned before you voted, right? Because it kind of has an effect, but we're not going to talk about that. All right.
Yeah.
So just to circle back to the step up in basis, I want to make sure that everybody understands what that is, right? Step up in basis. You buy a property today for 300,000. You have a nice little duplex. 100 years from now, you die, right? We're all going to die someday. That property gets transferred over to your heirs, your children, your grandchildren, whoever you want, right? But now, 100 years from now, that property is worth $3 million. It's no longer worth 300,000. You pay 300,000, but in 100 years, that's 3 million. Your heirs would get that property at the value of $3 million, not 300. So you take advantage of the depreciation of the property while you're alive, right? You get all the tax benefits, the deductions, you pass on, your kids get it at 3 million. They can sell that property for $3 million the very next day that they receive it for $3 million and not pay any taxes, because they have what's called a step up in basis from 300,000 to 3 million. That is like free money. Like you're not paying any taxes on that gap, on that difference. So what Biden is proposing, he's saying we need to eliminate that step up in basis, because a lot of people are not, everybody's saving taxes on and doing a step up, and we're not getting the money that we want. So that's a huge one for me. I mean, I don't like that at all, personally, because when I die, I want to be able to transfer property without having to pay taxes, right? Okay, so this is what the new proposal is expecting in revenues. So the majority of the revenues are going to come from the additional corporate tax rates, and also from taxing those individuals 400 who are earning 400 and above plus, right? So the majority, 2 trillion, going to come from those two. The rest is going to come from the miscellaneous items that he wants to change. He's proposing he changes. All right, so that goes to show that the majority of the tax revenue that he's proposed, the expected tax revenue he's proposing is coming from individuals, not so much the big corporations. Only a third will come from the big corporations. So everybody's affected. I don't care what anybody says, everybody's going to be affected. Okay, so there is talk, this is not on the proposal, but there is talk, there's a senator in Washington from Massachusetts, I forget her name, Warren, last name Warren. She's proposing,
Elizabeth Warren. Yep.
There you go, Elizabeth Warren. She's proposing a wealth tax, taxing people with $50 million in assets at the rate of 2%, just for owning assets, which is ridiculous. So you own assets, so I'm going to tax you. I'm not going to share opinions. I'm just going to state the facts. I take back what I said. Ignore the ridiculous comment.
Am I going to have to do my same disclaimer? The views of Jose Ramirez are not directly the views of the Broward Real Estate Investors Association or the Miami-Dade Real Estate Investors Association, and they are only the opinions of Jose Ramirez.
I have very strong opinions about these changes.
Before I get all those emails saying,
right.
All right, I like Jose, but
yeah. He's a little bit too opinionated. Yeah, I get it. All right, so what do we know, right? So we know that people in the range of 400 plus are going to be affected. That's the magic number. Business owners are going to be hit the hardest. 2021, as it relates to tax planning, we kind of have to do it carefully because we don't know what's going to happen in 2022, right? Now, higher taxes are a chronic condition. This is not the first time the taxes are going up. They go up all the time. And to be completely honest, right now is the lowest taxes we've had in a long time. So there are tax planning around that, right? Take advantage of the low taxes that we have now to, convert things like your traditional IRA into a Roth. Carefully planning the conversion because you don't want to over convert either, right? There's strategies around that. So the point of these slides are to tell you that there's always going to be planning available. It doesn't matter who's president. It doesn't matter what the tax laws are currently or what they're going to be. You always have to look at your tax plan because it's always going to change. Okay.
Yep.
Keep that in mind.
So I just had to go ahead and put in the chat. How many of you guys actually tax planned or actually, if yes, no, maybe, I never thought about it. I don't pay taxes. I'm going to turn you in. No.
Tax plan because I don't pay taxes. That's a great one.
So yeah, how many people actually, you might have been using an account, same account for years. And, are you actually, planning? Like actually have an idea. Okay. Yeah. David needs a tax account.
The
Sam, okay, you
TurboTax
paying
plan.
taxes.
No, TurboTax is not tax planning, guys.
Yeah. Okay. Current CPA, real estate tax account. Okay. Yeah. So Christine, expensive account, but not a lot of planning. So
That
can
happens.
we, Jose, can we just touch about this? I know I kind of joked about saying all the accountants are not created equal. Do you want to help expand? So one of the things I'm going to start saying is just because they're a CPA, it does not mean they're a tax strategist.
Right.
There's a huge, huge distinction. What I didn't tell you also, Jose is also a real estate investor. He owns Airbnbs. So not only is he a tax strategist, and he focuses on, I think almost 90% of your clients are either e-commerce or real estate, right?
Well,
I don't think you
I would say
differentiate.
like 80% of my clients are real estate and everything else is 20%.
Okay, so if you want to just kind of touch on, what it means to be a tax strategist versus another
Yeah,
accountant.
absolutely. So, if your accountant, your CPA, your advisor, I saw a comment come in that, my CPA, it's expensive, but he doesn't do any planning. And that's not their fault, right? The planning has to happen with you. Like a lot of accountants out there and a lot of CPAs, they're just focusing on compliance. They want to make sure that you are filing your tax returns timely, that you're not paying any penalties, and everything is reported correctly. That's primarily their job, compliance. Now, a strategist is going to do that plus planning, but you have to reach out to your advisor and say, hey, I want to do some tax planning. What strategies do you have for me for my business? How can I save more in taxes? An accountant, a CPA they may or may not offer that service. So you want to make sure that you're working with the right person. When it comes to real estate is more of a complex business because of the depreciation component. You have the real estate professional status that you may qualify for. And if you do, the tax planning opportunities are tremendous. So if you're working with an advisor, you want to make sure that number one, they understand your business. They understand real estate. They understand what a cost segregation is. They understand what the real estate professional status is, right? If they don't, then you need to find somebody else.
Yeah. So if you're a landlord, here's some couple key questions. If you're a landlord and you ask your tax preparer, accountant, CPA, mom, whoever you're using, if they don't know what a cost segregation is, okay, you might want to look at someone else.
Yeah.
If they don't understand what, the professional designation, as a real estate professional, you may want to talk to someone else.
Right.
If you're not depreciating your assets, you may want to talk to someone else. So those are three
That's a common mistake.
easy questions.
That's a very
Right.
common mistake. A lot of landlords, I've seen some landlords that come to me, they don't depreciate their property, which is a huge mistake. Because this is what's happening. When you don't depreciate your property, you're not taking advantage of the depreciation expense. It's a non-out-of-pocket expense. But at the same time, if you sell that property, you're going to have to recapture that depreciation that you didn't take. The IRS won't care that you didn't take it. They still want it back. So, you want to make sure that you're working with the right person. All right, so let's keep going here.
Mhm.
The why tax plan, right? Tax planning is key to financial defense. You can guarantee results. When you tax plan, you're going to know exactly how much you're going to pay in taxes. You're not just like hoping your accountant, your CPA at the end of the year waves his little magic wand and says, boom, this is your tax bill. You're going to know exactly what you're paying because now you've implemented strategies to lower your tax bill. All right. So we kind of think of it as the red light and green light model. I got this from a mentor of mine, a tax attorney from many years ago, who used this this analogy, I guess. The green light and the red light. The green light means that you pay, basically. You're doing compliance and you're paying the tax on the tax return that's prepared while being in compliance. The green light model, the green light is the tax planning strategies. That's when you use the code. Things like, let me go over my slides here, more in detail here. Tax code, section 1 is tax imposed, section 1401, self-employment tax, section 1411, net investment income tax. These are all red lights. The green lights will be things like tax planning strategies, medical reimbursement plans, charitable contributions, tax-free loans and withdrawals, right? So these are the strategies that are available to you to implement in your business. But if you don't know about them, you can't implement them. If your advisor doesn't know about them, he can't recommend to implement them, okay? So these are the things that you need to know. Okay, so how does the tax system work? It's actually very simple, right? You're gonna add up all your income from all sources or business sources. You're gonna subtract any adjustments to your income. You're gonna subtract your standard or itemized deductions. You're gonna consult the tax table, which we looked at earlier. You're gonna subtract any credits that you may qualify for. You're gonna add any additional taxes and then write a check to the IRS. You're done, right? This is the whole tax system. That's the way it works. What's included in income? You have earned income, you have business income, interest, dividends, capital gains, pensions, alimony, gambling, illegal income. Yes, illegal income is taxable, all right? So this is what's included in your income bucket. Then you have adjustments to your income, things like contributions to IRAs or 401ks. You may have moving expenses. You may have self-employment tax adjustments, health insurance, retirement accounts, alimony paid, student loans interest. These are all adjustments to your income. Then you look at the tax rate, the tax table, right? Then you take your standard deduction. If you're single, this is what it is, head of household, married, filing jointly, and so forth, right? And by the way, if we go back to the 2017 standard deductions, this is what they are. They're a lot lower, okay? After you apply your standard deduction, you're going to deduct your itemized deductions, you can take your standard deduction or use the itemized deductions, one or the other, right? And what's in your itemized deductions? You have medical expenses, local state taxes, foreign taxes, interest, casualty, theft, charitable gifts, miscellaneous. These all go under your itemized deductions. You pick one of the two. And then whatever's left over, you multiply that by your tax rate, depending on which tax rate you're in. You apply the tax credits after you come up with your tax bill. So family credits, education credits, foreign tax credits, general business credits, real estate credits. Then you have self-employment tax, other tax, and you come up with your total tax for the year, right? Pretty simple. I mean, there's a lot to calculate, I know, but it's pretty simple if you look at the big picture, right? Income, adjustments to income, deductions, credits, and that's your tax.
Yep. And
All right.
Jose, before you go anywhere else, I'm just going to go through a few questions.
Sure.
So Alicia is asking, may I change a PA for S Corp anytime during the year?
You can. You can, depending. So the way the S Corps are converted, they have to be done before March 15th. If you do it after, there's a way to do it retroactively via a hardship letter. But the answer is yes, we can do a conversion.
And you could do that for them. I know people always ask.
Yeah,
hey,
you can reach out to us.
Can they do it? And so the other questions I always get to. So Jose actually has a full accounting services company. So pretty much all the things that we're talking about, he could do all those things for you. So Sam's asking, can we deduct our goodwill donations if we're not itemizing the deductions on Form 1040?
Normally, no. So you have to itemize to be able to deduct your charitable contributions. However, this is a one-time thing. 2020 and 2021, because of the CARES Act and COVID fiasco, they are allowing up to $300 to be deducted from your income on the 1040 without having to itemize. If you contribute to charitable places. non-for-profit type places.
Perfect.
Yeah, great question.
Yep. Steven's asking, I know you were talking about, about Biden's tax bill. So he's asking if it does get passed, will they make it retroactively for that year?
Yes. Yes, that's what it sounds like at this point. They would make it retroactively.
Yep. So again, it hasn't passed yet. We're just talking about, what we wanted to do today was kind of have like a foresight of what's been kind of bubbling around, and versus waiting until, the day it happens. Anything that Jose's talking about, they might alter certain things to it, but this is what's, been proposed so far. So let's see, are financial planners usually tax planners, or should I look for two separate specialists?
What was the question? Financial planners?
Financial planners and tax planners, are they the same people, or
No.
are they two different?
Not normally, unless they do both. But financial planners are usually people that are helping you with your managing your money. Putting money away in retirement accounts, life insurance, universal life insurance, things of that nature. But they're not tax experts. They're not. They may know a little bit. They may dabble, but they're not special unless they do both. And we actually, Anish, you don't know this, but we're actually adding a financial arm to our practice.
Are you? Okay.
We're adding it actually next month. Well, we started already this month, but we're still working the pieces out. We're adding financial services and insurance to our firm. So we're going to be a full.
Oh, that's fantastic.
Full service,
Yeah, I'm just going to add to that. Just even from my experience, I don't know one person that does both effectively. So even same thing, like Jose knows obviously tax strategy, but you're not really a financial planner. You're not talking about life insurance or stuff like that too. So it's a little bit different. Generally speaking, you're going to want two different people. But now that I guess Jose announced it, is that next month, starting next month, which is what, next week?
Next week. We're adding a partnership with, we're adding a partnership with, we're going to be working with a lot of like Transamerica, and we're going to be working with a lot.
Okay.
We're going to be like the Amazon for products, for financial products. Anything you need, we're going to be able to connect you to the company directly. So it'll be interesting. It'll be fun because I'm going to be involved, and I'm going to be able to make suggestions from a tax perspective and from a wealth growing perspective. So
awesome.
Excellent.
Sounds good. So that was all our questions for now. So I'll let you hop back in on your presentation here.
Okay. All right. So when it comes to tax planning, the key things to remember is that there are four components, right? There's timing, there's shifting income, there's the code, and there's products. Timing will be things like kicking the can down the road by doing a pre-tax 401k or something like that, deferring taxes. Shifting income will be something like hiring your family members that help you in your business that are in a lower tax bracket. You could hire them and save tax. Your business would take a deduction, and the income that they receive, they will not pay taxes on, depending on how much you pay them. Tax code, tax code will be any tax strategy that the tax code allows, such as medical reimbursement plans, things of that nature. And then products would be some, things like insurance, universal life insurance, which are great. We can touch on that later. All right. I always like to put in a slide on the audit paranoia because there's a lot of misconception out there on the audit paranoia. And my percentages, I lost it. Here it is. My percentages are not showing up. But, out of all the audits that the IRS does, really the majority of the audits are going to be for Schedule C filers. As you can see here, Schedule C from 25,000 to 100,000, the audit percentage is 0.9%. Anyone from 100 to 200,000 is 2.3%. And that is because I'm going to make some assumptions here, but the IRS understands that if you're a Schedule C filer, you're self-employed, you're not very complex in terms of doing your books and your finances. So I'm of the opinion that they pick on the little guy, right? They pick on the little guy. They know that you're a self-employed individual, and they know that you're probably not keeping track of your receipts as well as you should, because you're not a corporation. Corporations are treated a little more formally, right? So if we look down here, S corporations, the audit risk is about 0.25%. So it's very minimal, right? We love S corporations. S corporations are great. They get audited the least. There's a lot of strategies around it. It saves you a lot in tax as long as you have enough income to justify the S corporation. All right. All right. We're going to go over selecting the right the right tax entity for your business. So as you may know, there are 4 entities, tax entities that you can operate under. We have the sole proprietorships, which are really meant for self-employed individuals. Somebody may be starting out, wants to do a side business, business on the side. You are going to be paying self-employment tax, which is at the rate of 15.3%. You are going to have to come up with your estimated tax payments, estimate your net income and multiply it by your tax rate and send that into the IRS on a quarterly basis. It's simple. There's no requirements. There's no formality, right? You can operate under your operating, your personal account if you like. There's no restrictions. You don't have to have assets under the business name. They could be under your name and you can use them for the business. So they're very simple in that regard. Then you have the partnerships, which are by default, when you set up an LLC with 2 owners or more, but the default entity is going to be a partnership. Partnerships are primarily used to own assets. We like to use them to own assets. They do pay the 15.3% in self-employment tax if you're using it for an active business. If you're using it to hold assets, it doesn't. It has more flexibility. There's no restrictions on how to distribute the money. If you're doing withdrawals or distributions to the partners, you have a little bit more flexibility there. Then you have the corporations, the C corporations. Those are good for setting up fringe benefits. It's taxed at the 21% rate as of today. There is double taxation. I'm sure you heard C corporations pay double tax. And that is true. That's not a myth. You're paying taxes at the corporate level at 21%, and then you're paying taxes on the income that you receive from the corporation on the personal level. All right. There are no restrictions to shareholders. You can have foreign shareholders if you like, no restrictions there. There is corporate formality. You have to do a separate corporate tax return. You have to have your board of directors meetings, elect board of directors every year and that sort of thing. So there is a little bit of formality associated with these. And then the last one is going to be the S corporation. The S corporation is what's popular among active businesses like mine. I'm an S corporation, and most real estate wholesalers are going to be S corporations. Why is that? It's because it has no corporate income tax. It's a pass-through entity. So any income that the S corporation receives or nets is going to flow over to your personal return. You can put a cap on the self-employment tax, the 15.3% self-employment tax, by paying yourself a salary, a reasonable compensation salary. Okay, there is no double tax. The S corporation does not pay tax. So you're eliminating the 21%. All right, everybody with me? I see a question on here. Somebody's asking about the LLC, great for real estate. Yes, LLCs are great for real estate, but depends on your question. If you're talking about holding real estate, yes, LLC without the S corporation is great. If you're a wholesaler, an LLC tax as an S corp may be best for you, but it depends on your income. All right, which brings me to the next slide. Why do we like S corporations for wholesalers? I'm glad you asked. We'll go over that. So I'm going to go over an example of a sole proprietorship. Sole proprietorship that is, let's just say it's a wholesaler, right? So the sole proprietorship reports its net income on Schedule C, and it pays the 15.3% on the entire net income of the Schedule C, right? The S corporation, on the other hand, takes the entire net income and splits it, and it doesn't. There's no formal official way to split it. It really depends on the individual, the owners, and the activity. It splits the income between a salary and net income for the corporation, right? So you're only paying 15.3% in FICA tax on the salary portion, not the income of the corporation. So that's where the tax savings come in if you have enough income to justify an S corporation. So it avoids the FICA tax in this portion of the income. Everybody see that? we're going to go over an example here and show you in detail how the savings work. Okay. So on the left, we have a sole proprietorship netting $120,000 a year. The owner is a wholesaler. He's netting 120,000. He's going to be paying self-employment tax in the amount of 18,360. Okay. Deduct that from the 120, you're left with 101,640 after you pay your self-employment tax. Same scenario on the right, but now you're not operating under a sole proprietorship anymore. You're operating under an S corp. You pay, same scenario, 120, but you pay yourself a salary of 60,000, right? We're going to assume that the 60,000 is a reasonable compensation for the work that you're doing in your corporation. On that 60,000, you're paying 9,180 in self-employment tax, the FICA tax, which is half of what you were paying as a sole proprietorship. Everybody see that? So your net is 110,820. So the savings are $9,000 just by having the right entity. This is important, guys, because I've seen a lot of people come to my office with a sole proprietorship making 300,000, 300,000 or even more. And they're paying a lot in self-employment tax, not realizing that they could have saved money by converting their entity, having the correct entity. Okay.
Yeah, I just want, Jose, I also want to just add, I know you're saying wholesaler, you could be a rehabber too. This is active income.
Right.
This is,
Wholesaler,
you could be
rehabber.
a licensed real estate agent, you've got your PA being paid, anything active. We're not talking long-term.
Right.
So it's not just wholesaling. You might, some of you rehabbers are getting in and out of a house pretty quick in 3 or 4 months. It's the same situation too. I know
Right.
Corinne's asking, how much wholesale income do you need to justify an S corp?
That really depends on how much time you spend doing your business, right? But I always say somewhere around 40,000 net, 30 to 40,000 net. It may make sense to convert it. Yeah.
Perfect. Sam's asking you, my business is an S corp Inc. How can I change it to LLC S corp?
Well, if it's already an S corp, you want to have a conversation with one of us because when you convert, are you saying that you want to have an S corp? You already have an S corp?
It
See,
sounds
converting an
Yeah.
S corp to something else always trigger, depending on what the assets are, it always triggers a liquidation of the S corporation. So if it has assets, it may not be recommended. That's a conversation that you got to have with an advisor. You can call our office.
Yep.
Right.
Let's see, anonymous. Why would someone decide to prepare a partnership tax return versus reporting their share of income on a Schedule E, page 1?
Wait, I didn't get the first part of the question.
Yeah. So why would somebody decide to prepare a partnership tax return versus reporting their share of income on a Schedule E, page 1?
Well, a partnership return is needed for a partnership business, right? So if you have an LLC that's owned by multiple people, the default is going to be a partnership. So it's not really that you decided, it's what you have to do to stay in compliance. Why? Maybe you decided to operate under a partnership over Schedule E because it offers you more protection, right? The protection aspect of it is nice. Which is why most people set up an LLC to begin with.
Jeff's asking, are the income amounts given for audit the gross or net income?
Are the income amounts given for audits?
Net income. Yeah, you know what he's asking when you had the graph up there. So it's going to be your net income, right? You're going to have minus all your deductions. Like when you're showing the Schedule C, if they make between.
Oh, those are just percentages of the types of entities that get audited the most. They usually audit a section of the return or the entire return. They usually, they may audit the expense, the income, or the entire thing. Depends.
Yep. And I'm sure there are people who are probably watching who are now going to decide to switch over from sole proprietorship to an S corp. So I'm sure there are fees involved in that. Can you use those fees as tax deductions when you're switching over or converting?
Yeah, any expenses you incur to maintain your business, to keep yourself in compliance, is going to be tax deductible, right? Because you're paying a professional to help you with your business. Absolutely. Great question. Yeah. You guys ready to keep going?
You keep on going.
All
I know
right.
you got a lot of info, so
Yeah, these are just the steps. I mean, I run into people who just, filed an LLC with the state, they pay the fee and they think that they have everything covered. But in reality, you have to do a little more than that, right? You have to prepare the minutes, select your board of directors, have a waiver of minutes, prepare the bylaws or operating agreement, depending on whether you're an LLC or a corporation. You got to file your SS4 with the IRS to apply for your EIN. If you want to apply for the S corporation's election, you have to file Form 2553, buy your corporate kit, which is basically a folder. You stick everything in there, and now you're in compliance. If you ever get audited, you have proof that you're operating under a business. You're good. If you don't have all these documents, you're probably missing a couple of steps. Okay, and you may want to talk to somebody about that. Keep that in mind. Once you have your corporate documents in place, you go to the bank, you open up a business account, and you're off to the races. You're in business. Okay, missing depreciation. This is a very common thing that I see from people coming from other places, right? You mentioned earlier, Nish, that that's one of the distinctions of working with somebody that understands real estate versus not. Depreciation is a big deal. And especially if you're a full-time, well, it's always a big deal, but if you're a full-time real estate investor, you qualify for what's called the real estate professional status, which removes any limitations on your passive losses. You can apply your passive losses towards your ordinary income, which reduces your tax significantly or completely. And the way we do that is by applying your depreciation correctly on your rental properties, right? So you always want to have, if you're in real estate, you always want to, besides wholesaling, flipping, you want to add rentals to your portfolio because that's what's going to give you the power of depreciation. Let me explain depreciation for those of you who don't know what depreciation is. Property gets depreciated if it's residential property over 27 and a half years, if it's commercial property over 39 years. When we talk about depreciation, I get comments like, Jose, but what do you mean depreciation? Real estate is supposed to appreciate. Yes, it appreciates in real life, right? In the real world. But because you bought the property at a certain amount or a certain date, the IRS allows you to take a portion of that property. Let's say you paid $300,000 for it. You can depreciate that $300,000 over 27 and a half years as a non-out-of-pocket expense. And that reduces your income, your rental income, to a lot of times to zero or even a loss. Okay. So there are different components within a property. A property can have improvements. It has land, definitely has land, and it has personal property. So to best depreciate a property, a lot of the strategies that we use include a cost segregation to identify what's considered a 15-year property versus 5-year property, because those we can depreciate and expense the year that we place them in service. All right, so we have improvements are 15-year property. Personal property can be depreciated over 5 years, but with bonus depreciation, we can take 100% of it this year or the year that you place it in service. What's considered personal property? These are examples: cabinets, countertops, carpeting, dishwashers, appliances, wall partitions, all these, right? That's considered personal property. So if you have rentals and you're replacing any of these components in your property, know that you want to identify, don't just tell your accountant, I did renovations, $30,000, because that means nothing to us. The more specific you are, the better we can help you. Because if you tell me you replace cabinets, now I know that I can expense cabinets this year and I don't have to depreciate them over 5 years or over 27 and a half years. Okay. So the more detailed you are, the better. Bonus depreciation. Bonus depreciation was increased to 100%. It used to be 50%, but Trump raised it in 2018 to 100%. So anything that's considered 5-year property, 15-year property, and even 20-year property is considered to be assets that you can depreciate 100% of it in the year that you place it in service. So let's just say, I'll expand on that. You buy a property for $300,000, you have a duplex for $300,000, you back out the land is $25,000, you're left with $275,000. Normally, you would depreciate the property over 27 and a half years, which is $10,000 a year. But if you can identify the kitchen cabinets, countertops, carpets, machinery, furniture, fences, driveways, all these things, all these components within the property, if you can identify those, we can take the value of those components and take the expense in the year that we placed in service or bought the property. That is huge, all right? And I'm going to explain that why in a minute. Okay, identifying a lot of mistakes that I see, identifying repairs versus improvements. Repairs would be things like patching up a wall. You know, you can deduct it now. It keeps the property in good condition. They don't add value. It's just a simple repair of something existing. Examples will be paint, plaster, repair broken windows, fixing gutters. Improvement is something that you're replacing and you have to depreciate over time, right? It adds value to the property. It prolongs the property use. Examples will be things like room additions, upgrade appliances, landscaping, replace components. This is very important. You want to keep track of this because a lot of people, I don't want to say a lot of people, but sometimes people make mistakes and they do an improvement or an addition and they think it's an expense. Well, it's not. Okay, you want to track that you want to be very detailed when you're tracking that. Investors versus dealers. This is another common misconception or another issue that I run into on a regular basis is that people they don't understand the difference between being an investor and a wholesaler. Also, a wholesaler is basically a dealer. You're dealing with real estate. You're selling real estate. You are an active business. You're subject to the self-employment tax. Okay. So you buy with intent to resell, ordinary course of business. This is your business. You're not just investing in a piece of property to hopefully sell it for more later. There is no depreciation on the property you buy because you're buying it to sell right away. It's considered ordinary income. There's also, you can't do a 1031 exchange on properties that you buy to resell as a dealer. Investors is different. Think of the word investor. The definition of an investor is somebody who buys something with the expectation of selling it for a higher price in the future. But we don't know how long that's going to take. It can be a long-term investment. It avoids self-employment tax. You're only paying capital gains on the gains. Depreciation deductions, maybe capital gains, and it qualifies for the 1031 exchange. All right. Okay, here's an example of a cost segregation. I think that slide was out of order, but that's okay. So cost segregation study is going to help you identify what components are included in the property. So going back to my example of the $300,000 duplex, you back out the land for $25,000, you're left with $275,000. Well, this is close enough. This property was actually $202,000 after we backed out the land. I think the property was purchased for $340,000. The land was about $130 something, and we were left with $202,000 down here. Everybody see that? Oops, $202,000. So out of the $202,000, we were, after doing a cost segregation study or report, we were able to identify the 5-year property being $27,000 and 15-year property being $25,000. Okay, so this generated an additional deduction of $52,000 in the first year. Okay. At the time, this taxpayer client was at a 35% tax bracket, so his tax savings were $18,000. If you take the $52,000 in additional depreciation that we generated by doing this report, the tax savings were $18,000. That's pretty significant, right? That's something that he would have missed out on had he not done the cost segregation report. So this is what it looks like. It gives you a breakdown of the components in the property. This is going to be your 27.5-year property, which is considered the actual building structure and interiors, right? Things like windows, roof, tile. And then what's more important here will be the 5-year and 15-year property, because we can expense all of this in the year that the property is placed in service. Make sense? This is powerful. This cost segregation reports are powerful because it allows you to accelerate depreciation. And then if you qualify for the real estate professional status, which we'll talk about in a second, it's going to help you reduce your ordinary income. A lot of my landlord clients don't pay any taxes because they understand the power of owning real estate. Depreciation is very powerful, right? You want to be able to apply as much as you can towards your ordinary income, so you pay less taxes. All right.
So yeah, I'm just going to kind of touch on it. So I know it's a lot of information. We're trying to show you what's possible out there. Can you do this by yourself? You cannot. You're going to need a professional to get this done. I think you said, Jose, am I going to get this wrong? But so if it's a smaller property under the $500,000, you could do it, and it's about $1,800
Right. If
to
it's
get
a
this
small
done.
property, a small property under 500,000, we can do it for 1,800. So, I mean, would you pay $1,800 to save 18,000 in taxes? That's an all day thing. All day, yes.
Yeah,
It's
and
just a
the
matter
thing
of
is,
having the right. Yeah, go ahead.
and the second point of that is that's why, Jose's more, I don't know, I don't want to say wealthier clients, but I'll say wealthier clients that are in real estate, they actually don't sell anything.
Yeah.
So they're building their portfolio, right? So instead of paying Uncle Sam $20,000, $30,000 or whatever that number is, take that money and buy another property.
Right.
And you're leveraging it. And
Yeah.
this is how you're building portfolio. Again, this cost segregation or depreciation, those are not real losses. This is losses as per the IRS that's approved, if that makes sense. Am I saying that right? Or
It's just a paper loss, basically, based
paper
on
loss?
what the real estate is,
Yep.
So,
So I got a couple of quick questions too. We'll just kind of run them through. Ruben's
Yep.
asking, can you amend any missing depreciation or any mistakes from previous tax returns prepared by our accountant or CPAs?
the answer is it depends. The answer is depends. Once you do it for more than 2 years, then you have established a depreciation practice and you can't amend. If you do it 1 year, yes, you can amend it and just correct the 1 year that your previous practitioner did not do correctly. So it depends, right? There's so many rules around the taxation and the IRS that you really need to know how to fix some of these things. If you do it for 2 years or more, there's a way to correct it, which is via an accounting method change. You have to do a depreciation analysis. It's a little bit more entailed than you. The moral of the story is that you don't want to make these mistakes because these mistakes are going to cost you a lot of money to fix. Okay.
Yeah.
It's going to cost you more in taxes when you sell the property, if you ever do sell the property. And it's going to cost you fixing it because now you have to do a correction. You have to do a depreciation analysis on what the depreciation should have been versus what it was. Present those corrections to the IRS via an accounting method change and submit it, right? But it's a lot of work. It's not just like preparing a correction on the return. You have to do analysis.
Yep. And I'm going to follow up on the cost segregation. How fast or slow, like let's say you have a piece of land, obviously they have to get you paperwork showing the repairs and like what would that take,
So
like in
the
time-wise,
focus,
like
yeah. So if you have the HUD, you have the appraisal, and you can answer some basic questions about the property, we can get it done within 24 hours.
oh wow, that quick, okay.
Yeah, we do a desktop. We do it all online.
Underwriter appraisal.
Yeah.
Okay, perfect. Lizanette's asking, do you have to be a real estate professional for tax purposes in order to claim depreciation?
No, depreciation is something that you must claim if you're renting out property. If your property is engaged in business, is being used in business, it has to be depreciated. That is just a matter of law, right?
Yeah. And now the second question, I mean, I know the answer, but what happens if it's my second home? Can I depreciate second homes versus an investment property?
No, because it's not a business, right? Second home is your second home. You only depreciate assets that are used in a business.
Perfect. And then, the third question that always pops up, and I know you have some Airbnbs. What happens if it's on a traditional rental and it's an Airbnb? Can I depreciate the property versus
Going back to depreciation requirements? Depreciation is not a matter of choice. Depreciation is a matter of you have to do it. If the property is being used in business, depreciation must take place. If you don't depreciate, you're doing it incorrectly, and it's gonna bite you later. You want to correct it.
Perfect. Can someone be an investor and a dealer at the same time?
You can have two separate activities, sure. An investor will be somebody holding property to rent, right? A landlord can be a wholesaler as well. But you want to make sure that you're separating the activities. You don't want to have it under the same entity because there are two activities completely.
Yep. Lizanette's asking, do you need to do the cost segregation study at the time of putting the property in use, or can it be done after the property has been in rental use for years?
You can do it after the fact. It's a different process. It's always better to do it when you first get it, but yeah, you can do it after the fact. There's just, we have to do what's called an accounting method change to do the 481A adjustment, basically is what it is.
Yep.
Yep.
And Alicia's asking, if I buy a home for myself and then I convert it into a rental property, does it apply for depreciation and tax deduction?
Yes. So if you have your primary home that you lived in and then you convert it into a rental, when you convert it to a rental, it becomes a depreciable asset. So you would start taking depreciation from the moment it becomes a rental.
Okay. Christina's asking, does it matter if the property is titled in our personal name or a business? For
Depends on who owns the property. Oh, I'm sorry. Okay, so that's the question, right? Who owns it?
Yeah.
It really depends on your preference, right? If the business owns it, it's got to be reported under the business. If you own it personally, it's got to be reported on your personal tax return.
Yeah, and Christina is just saying if it's used as a rental, but I think it still just goes back to what you titled it as, right?
Yeah, I mean, if it's titled to your business, then you want to report it under your business name, under your business tax return. Depending on the entity that you're operating under. If you're an LLC, sole proprietor, single member LLC, sole proprietorship, it's going to be reported under your personal tax return anyway. But if you have it under a partnership, then you have to do a partnership tax return.
Yeah, and Javier is asking, is it better to incorporate each property you own?
That's a great question, and we get that question a lot. It really depends on your risk tolerance. I mean, number one, you never want to have real estate assets owned by a corporation. That's a big no-no for us, unless you're a wholesaler. But if you're holding rentals, you never want to hold it under an S corporation. It really depends. I mean, if you ask an attorney, a litigator, they're going to tell you buy each property under an LLC. I mean,
yeah, and so that's the problem, right? So it's going to be your risk level, just like what Jose is saying. If you have 100 properties, you do not want 100 LLCs, because your operating costs are going to be a ton. So we have a guy I know that does own a little over 100. He feels comfortable putting 10 properties in each LLC.
right.
So it just really depends. And again, if you talk to the attorney, he's going to tell you one thing. The accountant's going to tell you something else. Your finance guy, if you're trying to take out the money, will tell you something else. Right. So the idea is to actually talk to all three and figure out where your comfort level. And then the fourth person that's going to be different is your insurance guy. So he's going to tell you a fourth different thing. So there is no clear-cut answer. And if you've noticed, Jose's saying it depends. The reason is this is not a cookie cutter thing, right? So we're giving you a general broad stroke. As you start, attaining more properties, maybe you're rehabbing more. As those strategies change, you want to be talking to your tax preparer. Jose, most of your clients, on average, they talk to you twice a year for tax preparation, or
twice or three times a year. We review things in the beginning of the year, then mid-year now, and then towards the end of the year. Yeah.
So like you want to be like, I'm not saying you should have them on speed dial, but like you're doing your dentist appointment, your teeth cleaning, you better do your financial accounting cleaning and and basically talk to your tax preparer, right? So I think that's always important. Patty's asking, is a fix and flip rehabber holding for 3 to 6 months considered a dealer to the IRS?
Depends on the intent. If that's your business, if you're engaged in the business of wholesaling and rehabbing property, then yes. There are multiple factors to consider. It's not, if you do a one-off, it may not be, but depending on what your intention is.
Yep. Jeff's asking, does the IRS have some kind of schedule they use to determine what amount of rent should be paid for a particular kind of rental unit? If so, what? I would say no on that.
No, I mean,
Yeah.
that's really based on market.
Yeah, so the IRS doesn't care, like, to be honest. Like, what they're gonna do is, whatever you're gaining for rent, that's what you're gonna do. Like, so that's gonna count as income. Let me rephrase that. So,
The question was rental income, right? What the rental income should be.
yeah, the IRS isn't gonna tell you.
It's going to be, it's
Yeah.
going to depend on the market. I mean, you want to collect a fair rent. You can't,
Correct. And actually, maybe Jeff, the question might, the answer might be more something is if you're doing Section 8, if it's government subsidized, each county will tell you, what you should be getting for 2 bedrooms, 3 bedrooms. That's something different. So that's what I would tell you if you're looking at that. I know Tito's asking, I know you kind of mentioned this, but why not rentals under an S corp, right? It's active income versus long-term.
yeah.
Could be-
Okay, the short answer, and that's a long answer, but the short answer is
know.
going to be the IRS has restrictions on S corporations having more than 25% of their income from passive activities. If the IRS catches you, they can revoke the S corporation and make you liquidate the assets, and you'll be paying capital gains and tax you at the corporate level. So it's a no from the IRS perspective, but also you have other issues like basis issues. If you have a mortgage on the property, any loans on the property are not considered basis to the owner, as opposed to a partnership or a sole proprietorship. You have more basis when there's a mortgage. So it's a matter of technicalities that you want to be aware of, and you don't want to understand 100% of this because it's very complex stuff and very technical. But just know that it's never a good idea to own real estate under an S corporation. All right.
So Ruth is asking if a house is titled as a land trust and I'm the beneficiary, not my LLC's corporation. Let's see, do I have a disadvantage for deducting taxes?
Well, the corporation can't make any deductions. The owner of the land trust can report it as a business activity. So you want to make sure that everything lines up, right? The title has got to be done correctly. So if Anish owns the property, you can't deduct that property because it's Anish's, right? Same thing with the trust. Who owns the trust? Whoever owns the trust can deduct it. All right. So keep that in mind. The lines have to align. You can't just, I can't start deducting Trump Tower because I like it. You know what I mean? So it's the same concept.
Yeah, and Jeff's asking the same thing. Is a land trust a good way to own properties? Any disadvantages? So what we're talking, with Jose's going to tell you a different way because he's going to tell you on the tax side. There are some disadvantages. So I'll tell you that on the financing side. So if you're going to try to get money out on your land trust and it's owned free and clear, you're not going to get money out. Traditional lenders will not lend on that. You'll have to go to more alternative lenders, and you're just going to be paying more on interest rate. Loan to values will change too. So
Right.
I'm not sure on the tax side if there's any disadvantages in a land trust.
It has no bearing. It's the same thing because it's a flow through entity, so it just flows. It has no, as long as it's titled correctly, it's fine.
Okay, awesome. So we have about 15 minutes left. I did we kind of gone over actually all the questions and stuff. So is there a few things that you want to?
Yeah, why don't we touch on the real estate professional status, because that's a big one for you guys. Okay, so one of the biggest strategies for you guys is going to be the real estate professional status, especially if you are a full-time real estate investor, realtor, flipper, wholesaler, whatever the case is. You guys have this benefit that somebody like me doesn't have because I'm a tax advisor full-time. I am a real estate investor, but not full-time, right? I hold property. So what the real estate professional status does, it allows you to net your rental losses from passive income to elevate them into non-passive so you can apply them towards your ordinary income. To qualify for this, more than half of your total personal services in real estate has to be in real estate, trades, or business. You have to materially participate and perform more than 750 hours of the services during the year in real estate. So 750 hours in real estate, materially participating. And if you do real estate and, for instance, you're a teacher at night you can't be a teacher more than you do real estate. The majority of your personal time has to be, personal services have to be in real estate. All right. How do you protect yourself from an audit on this? Because this is something that you could potentially get audited, right? Because this strategy is so powerful that the IRS may say, okay, let's just make sure that you're a real estate professional. So you have to keep track of your time logs, keep track of your time. So if you're showing property, if you're looking at property, you want to make sure that you're writing it down on a calendar, or get an app that tracks your time. You can just log in your time on your phone and print out a report on the monthly and yearly basis. You want to have detailed records, contemporaneous time logs with detailed services rendered. So if you are, for instance, meeting a contractor at one of your rental properties because they have to do a repair, he's going to give you an invoice. That invoice is going to have a date. So if you have a time record that says, I drove to my property and spent 2 hours with my contractor, that's considered time, real estate time. So now you have backup to that time that you logged, right? So that helps. It helps your case. And that's just in an event of an audit. You never know. You want to be careful and track all your time. All right. Material participation. What does that mean? Material participation, there are 7 tests. And this is important to know, because if you're not materially participating in the business, then you don't qualify. These are the tests. I'll go over each one of them. But there are 2, in my opinion, number 3 is the easiest one to qualify for. Let's start with 3. Each year, you participate in the activity for more than 100 hours, but your participation cannot be less than the participation of any other individual in the business. Meaning that if you hire a management company to manage your properties, that management company cannot spend more than 100 hours, more than the time you spent in your business. So you have to have at least 100 hours, interviewing clients, interviewing tenants, selling, buying, whatever the case is, right? Nobody else that works with you can have more hours. The second one would be, number 1, each year you must materially participate in the activity more than 100 hours. And it doesn't matter if anybody else has more hours than you, as long as you meet the 500 hours. That's considered material participation. Number 2, your participation in the activity for the tax year constitutes substantially all of the participation in such activity of all individuals, including individuals who are not owners of interest in the activity for the year. That is kind of vague, right? But it's doable also. I mean, if your participation constitutes substantially all of the participation and you're doing it all, you don't meet the 500 hours, you don't meet the 100 hours, but the participation in the business is substantial, then you qualify. Again, to qualify, you want to keep track of your time. That's going to be the primary key thing here. All right. Let's go to number 4. Your activity is significant. It's a significant participation activity for the year, and your aggregate participation in all significant participation activities during the year exceeds 500 hours. So it kind of goes back to number 1. Some of these are going to be very vague, and hopefully you never have to put this to the test in an audit. But if you do, you want to make sure that you track your time, because it'll help you defend your position in the real estate professional status. All right. And you need to understand these before you elect to use that status, because it is going to save you tens of thousands in taxes, but you want to make sure that you're doing it right. All right. Number 7 is kind of an easier one, I guess. Based on all facts or circumstances, you participate in the activity on a regular, continuous, substantial basis during the year. It's kind of vague, but if you're the primary person that's operating your business, then you materially participate, right? Again, the key thing is tracking your time, track what you do, not just the time, but what you're doing in the business, right? Whether you're meeting clients to sell property, to show property, you're rehabbing a property, you're listing it for sale, things of that nature. You're meeting with tenants, answering calls, all those qualify. Okay, this is going to be a little much, but I'm going to include on here what constitutes real estate professional time. Real estate property development, redevelopment, construction, reconstruction, acquisition, conversion, rental, operation, management, leasing, and brokerage. So if you're doing any of these or all of these, you can track your time and include it for your real estate professional status time. All right. Real estate professional for rental units. If you're a landlord and you want to take advantage of elevating your passive to non-passive, this is the time that you would track: showing the property for rent, inspecting properties, hiring and dealing with the management company if you use a management company. But remember, they can't have more time than you. Review and screen tenant applications and leases, doing improvements and repairs if you do them yourselves. I mean, you could have a contractor do them, but you want to manage them, right? And they can't have more time than you. Evicting tenants, writing ads, updating websites with property info, attending seminars and travel time. This is a gray area, but I've seen clients do this and get away with it, including your learning time, real estate learning time as part of it. Again, gray area, but you can include it. Purchasing supplies, materials, going to Home Depot to buy things for the property, responding to tenant complaints and inquiries. Okay, we're running out of time, but there are more things that we can do in terms of if you don't qualify with one property because maybe you don't spend 100 hours in one property, there's a way to take multiple properties and group them. You would have to make an election on the tax return saying that you're grouping the properties to qualify for the material participation. I don't like to do that because once you group them, you can't ungroup them. Or you can, but it gets more complex. You always want to try to qualify per property if you can. All right. Keep your time logs. Tax courts has ruled against the taxpayer in every case where the time logs were not kept. So if you have no time logs, forget it. If you get audited, you're gonna be paying back the taxes that you saved. You cannot produce the time logs at trial, so you have to have them. Keep contemporaneous records. Any kind of calendar will work as long as it's something that you can show the records. That's really what you need. All right, these are deductions. We go over these deductions with all of our clients when they become clients. We're running out of time here, so I'm kind of going to flip through the slides, tell you about these deductions. Your auto expense, business meals, home office deduction, travel expenses. Family employment is a big tax strategy that we use with our clients. I mean, if you have children and they're helping you in the business, it may benefit you to hire them under the business. The business gets a deduction, the child gets income, and without paying any tax if you pay them under the threshold of $12,400 for 2020. Medical expenses, there are ways to include your medical expenses as part of your business as an employee benefit. So depending on the entity you're operating under, it may benefit you to do a medical reimbursement plan. Okay. The Augusta rule is one of my favorites that I personally use, and a lot of people miss out on. Is the Augusta rule is where you rent out your real estate property, your personal property, for up to 14 days without having to pay taxes on that income. So you can hold conferences at your house, have retreats at your house, or have educational events at your house. Rent your house out to your business. Your business pays you personally for renting out your house for the day at a reasonable rate. The business gets a deduction, and that income goes to you personally without having to pay taxes on. It's a big deal. It works with Airbnb, business meetings, conferences, holiday parties. Airbnb, as long as it's not over 14 days. All right. Another quick hack for paying less taxes at the end of the year is you can prepay a lot of expenses. I mean, there's a lot more tax strategies that we have, but I can't cover everything in one presentation. But I will say that one of the safe harbors that we have every year at the end of the year is to prepay for expenses for 2022, right? Pay them in advance, like your rent. If you're a cash basis taxpayer, you can pay up to 12 months of your rent, and any services that you would normally already have, you can prepay it and expense it in 2021. It's a great way to shift, your expenses to the current year from future years. If you're having a good year and you're trying to reduce it tax-wise. So when clients work with us, we cover, deductions, legal entity structures, retirement accounts, insurance, loopholes, tax cuts, and now Biden's too. We consider those as well. Niche specific strategies. These are the things that we cover during our meetings. And what we do is we save people money in taxes. I mean, that's my staff accountant, Gene. Some of you may know him. So I'll tell you a couple of stories that I actually included in my slide here. The power of tax planning. I worked with a local broker years ago, and he was overpaying in taxes and didn't realize it. We decided to bring up a few ideas to pay less in taxes. You know, Francisco, he was a 36-year-old, and we were able to save him around $17,000 the first year and every year going forward. That's about $1,400 a month that he was saving after we implemented a tax plan. So think about it, right? Without increasing his income, no changes, he made no changes to his business, right? Without increasing his income, without reducing his expenses, without growing his business, without reducing his lifestyle, just doing tax planning. And then I ran some numbers for him. If he were to put the savings in an S&P, for instance, he, at the end of the 30 years, he would have had 5 million saved up for retirement, which is a big deal, right? The tax savings, and not changing anything, just taking the tax savings and putting it in the market at a conservative rate of 10. I think I did 12% here, right? It's a big deal. Without changing anything, just doing some tax planning, the savings get shifted to a growth account. Another client, Eli, he was doing Amazon sales, 2 million a year, and he didn't have the right accounting set up. He wasn't doing accounting correctly, and he didn't have the right entity. He ended up paying in 2018 $125,000 in taxes. After we corrected his 2019 activity, we structured the business correctly, took into consideration various forms of asset protections with the LLCs, reviewed multiple tax strategies. We made a plan, we implemented the plan. And the following year, we brought down his liability from 125 to 34,000. So that's a significant savings, 91,000 in tax savings just by doing some tax planning and working with the right strategies. All right. So that's the power of tax planning, guys. All right. That's what it is. All right. We're almost done here. So I'm going to bring up an offer, kind of like we did last time, Anish. We talked about doing an offer at the end of the webinar. If you guys
go for it.
You guys want to
I know
take
it's a special offer. I know it's a
Yeah.
special offer you're doing only for our Bria and Miami-Dade participants. So, so if you're hanging out, if you want to go ahead and throw your offer on there.
Yes. So here we go. If you want to work with us, or you want to get just a second opinion, or even a consultation, we have a couple of things, packages that we can share with you. Hold on one second. Here we go. Can you guys see that okay?
Yep.
Okay.
There we got it.
So I did three packages because I realized that some people are at different stages in business. Some people, they just need a consult and they need us to review their tax returns for prior years to determine what they did wrong or what they missed or what they did right, right? So that's the basic package. A quick review, an hour consultation with me, $497. Then we have the standard, which includes setting up your corporation. If you're getting started and you haven't done your LLC yet and you want to set that up, we'll include the LLC setup, your first year's corporate return, and an audit protection plan. Total value of this is about $12,000 once you consider the tax preparation, the LLC setup, and the audit protection plan. Then we have the premium option for $1,297. You get the LLC setup, the corporate return, it's included on there the first year, the audit protection, 3-year look back to see what you've done in the past 3 years to determine if you missed any deductions or credits. And then you get an hour consultation with me. Total value of this one up to $13,000. So it really depends on what your needs are, right? If your needs are just a quick review of the prior activity, you can do the basic. If you want to set up your LLC, if you're brand new and you haven't set up your LLC, or you've set up your LLC but you don't think you did it correctly and you want to fix it, the standard will be good. It would include your corporate return for the first year and an audit protection plan. The premium will be if you need a little more than that. You need to set up your LLC, corporate return. You want us to look at your previous years, and you need a tax planning consultation. Make sense?
Perfect. Yep. Jose, do you actually, can you put that link actually in the chat?
I'm going to do that now.
Oh, okay. Oh, we actually have it already. Alexis are way ahead of the game for you.
Oh, okay, excellent. Cool.
Awesome.
Excellent. And that's it for now, guys. Actually, we did good timing. It's 12:30 and we covered a lot. Now, again, guys, the point of this webinar is not for you to become expert tax advisors. Like, you're not going to be me, but you want to know what strategies are available to you so that you can implement in your business. You can ask your advisor, your accountant about these strategies. And if they can't help you, go somewhere else. I mean, it makes no sense to be loyal to somebody that's not helping you. It's not helping you grow. Okay.
Absolutely.
Any
And
last
that's
comments
one
or
of the things that,
questions that we can?
well, actually, we're pretty full on the question, and some of these are like specific. So I know you guys are asking some super specific on your situation.
Yeah.
We won't have time for those because we're actually kind of over our limit also. Obviously, reach out to Jose. There's some good questions out there. And what will happen is he might answer that specific question. It's going to open up a can of worms because what happens, and I know this happens a lot, and my parents are accountants. So I know what it's like. You answer one question. The problem is, like, Jose needs a full picture of where you are financially.
Right.
So it might be the short version of an answer, but maybe that's not the most beneficial thing for you. So I think that's always kind of important. Number one, and and go ahead and talk to him. Let him do the the 3-year look back. I know a lot of you guys said you were missing things.
Yeah. Yeah.
So I think that's what's important too.
Everybody's different. I mean, some of you are married, some of you have kids. I mean, there's different strategies for families than people that have no kids, right? So we have to get a full picture of your lifestyle because some of the lifestyle also plays a part in the strategies that we implement. Location, all that.
Absolutely. I also want to make sure also tomorrow, usually we only do webinars on Tuesday, but we're actually having a special one with Francisco. Some of you guys were on our boot camp. That's where you might have seen Jose this weekend. Also, Francisco will be doing a webinar tomorrow about how to calculate property values. It's free also. Again, Jose has been doing this for a long time. If some of you guys are students, our platinum students, we pay for a lot of this stuff. Actually, it's premium package pretty much as a platinum student with over an $8,000 to $10,000 value. If we didn't trust Jose, we would not recommend him. That's what I tell people. So we really stand behind the hard work and like even today, like I didn't know all the proposals that Biden's talking about. So for me, I'm constantly learning. But again, reach out to them and, you'll have specifics and what you want to do, right? It's July, right? And you want to start planning for next year. Are you looking to buy some properties, right? Are you getting new to real estate? So just on some of the examples of the sole proprietorship, right? On that kind of stuff. The other thing I do want to also run by, because I know there's enough, I don't want to call them online gurus and stuff, and they'll tell you to do this and do that, and open up your business in Nevada and Delaware and all that stuff. So what I'm gonna, or have your LLC own the other LLC and do this. And when you're starting out, I'm just gonna tell you that's overwhelming. It's too much. So you want to have someone that's local that you could even get on the phone or actually even drive to his office and actually meet and figure out what your needs are. So
yeah, absolutely. And I will say this, just to add to that, Anish, I'm all for having multiple entities, but it's got to make sense to you, right? You may not need multiple entities to start. Wyoming is a great state to set up an LLC to own all your entities, but it may not be for you, right? It really depends. It's worth having a conversation with somebody that's already doing it and understands the tax strategies.
Yeah, it makes a very big difference. And Alexa just threw up a little poll. I know some people were privately messaging me about our mentoring program. So if you're actually interested in our coaching program, where we put up 100% of the money for the deals, let us know. You could also call our office. I'm doing appointments also. It could be via Zoom, phone call. If you actually want to come down and see if I have any legs and come to the office, we're doing in person also. Again, our first job is to make money. The second is to keep it legally. meaning pay the least amount of taxes. You don't want to be earning a ton of money and then watch it funnel out the bottom. I mean, you heard some key points, that $400,000 number, so you might not be there now. If you're doing this right, you might be there pretty quick.
Oh, yeah.
So on that, so Jose, any last words or anything that,
Yeah, just, nobody's going to do the tax planning for you, right? You have to be proactive about this. I mean, a lot of people don't consider the fact that we're paying taxes everywhere we look. We have income taxes, we have self-employment taxes, we have property taxes, we have sales taxes, we have capital gains taxes. There's taxes everywhere. And if you're ignoring the fact that we have all these taxes, you're going to end up overpaying in taxes at the end of the year. So you want to be proactive about this.
Yeah, and I'm going to give you my end of it. I know a lot of you guys, I hear this all the time through the RIA. It's like, I hate the accounting stuff. I hate the tax stuff. Well, what I'm going to tell you, it's part of your business. So you need a teammate on it. So don't ignore it. The worst thing you could do is ignore it or put it on the bottom. So just make sure whoever your tax preparer is, that you're at least talking to them twice a year minimum to figure out a strategy for yourself and your family. So again, thank you, Jose.
Thank you
once
guys
again for doing the webinar today. We want to thank our team here to making this a successful event. Ryan and I are still committed to doing a lot of free webinars. So we are happy that you guys are participating, asking great questions, and you can always email our office if there's topics that you are interested in. We have a big network here, so we could always ask one of our other corporates, whether it's insurance or whatever it is, to maybe do a webinar. So again, thank you so much. And hopefully we'll see you guys tomorrow at 11 for our next webinar. Thanks, Jose. Appreciate it.
Thank you guys. Appreciate it.
Have a great day.